Any prospect of ETFs?
We've thought about ETFs, and there's actually some nice tax advantages for individual investors in ETFs. The problem with it is that you have to post your portfolio on a daily basis. And we're doing a lot of proprietary work on our database and our factors that we think add value over time. And so we don't want to give those away to the rest of the world by posting our trades and our portfolios on a daily basis. So if you really think that you can add value, unfortunately, the way ETFs are structured now, you don't want to really be giving that away to the rest of the world, especially if you think what you have is really excellent. So while we would like to do ETFs, and there are some nice tax advantages for individuals, we can't. So we try to be as tax efficient as we can in our other strategies, but not quite as good as an ETF, but those are the reasons. I don't think we'd have the outperformance if we posted the ETF.
Now, in your world of indexing, you have relatively high fees. Was about 1.25% versus 17 or 18 basis points for the Vanguard. Your turnover would be higher too, wouldn't it, or not?
Right. Well, you know, I spent about 7 or 8 pages in the latest book, The Big Secret for the Small Investor, saying, well, is this real? Is what we put together really an index, or is it a an actively traded strategy? And it was a lot of on one hand, on the other. We have 800 to 1,000 stocks in what we call our value-weighted index. So in that sense, and it has more diversity, and actually it's more widely distributed than, let's say, the S&P 500, where the top 20 stocks in the S&P 500 can be 33% of your index. We're much more diversified than that. So in that sense, it's closer to an index. It is 800 to 1,000 stocks. It has the same beta as an index. It has the same volatility as all the other indexes. So in that sense, it's also similar to an index. But indexes have very low turnover in general. The reason for that is if you have a market cap weighted indexes, they actually change every day because market prices change every day of all the constituents. You just don't have to trade to get there. You don't have to trade to get those different weightings in the stocks. They happen automatically as the stock price moves. But
you have to look at the value of the stock each day.
When we're looking at value, so we do have to trade. So if you, for $1 million portfolio, we do about $3,000 to $4,000 worth of trading per day, which adds up to about 75 to 100% turnover, which is a little less than most active funds, but still a lot of turnover relative to indexes. So in that sense, it's closer to an active fund.
So in effect, you recalibrate each day?
We do. We could recalibrate every quarter. You know, in other words, there's something called the Russell 1000 Value Index. And what that index does, and that's a very well-known value index, but they do something different than us. They first, out of the 1,000 stocks in the Russell 1000, which are the largest 1,000 companies according to market cap, they pick the 650 that have certain value attributes that they look at, like low price book, low price sales, standard value characteristics. So they pick the 650 out of the 1,000 that have the best value characteristics, and then they market cap weight them. So they sort of do something that makes some sense, and then they do something that I think detracts significantly from the returns that you can have by market cap weighting that value index. So we could do something similar by staying true to our value weighting criteria and update quarterly, or every 6 months. But we find that because prices change every day, and because earnings change every quarter, and balance sheet information changes every quarter, we could update every 3 months or every 6 months, but we make more money by updating a little bit every day, and that was our goal, to actually
make more money for the investor, right?
Right. Our goal was to make money. So we kept our eye on that goal, and that's the best thing we could do for investors, and that's how we went about putting it together.
You've said business schools other than Columbia, where you're an adjunct professor, ignore value investing. Is that true?
To a large degree, that is true. They still
most schools don't teach Benjamin Graham.
Most business schools do not really teach Benjamin Graham. There are a few around the country that do, but for the most case, people are still being taught the efficient market model and all the math that goes along with that. We have found, we kind of feel the way Warren Buffett does is, that's good news for us. That, if everyone's told you can't beat the market and, this is the way to go about investing and it makes no sense to you and everyone's being taught that, it gives a little more opportunity to value investors if you have less competition. actually doing the work. So I think I constantly get emails and letters from business students all over who have been exposed to Benjamin Graham. And let me just say one thing to thank you and your dad. The way I got involved in value investing in the first place was from an article back in the late 70s in Forbes magazine that detailed Benjamin Graham's formula for beating the market. You know, Benjamin Graham was Warren
Right.
Buffett's teacher, and he had a nice formula. And I read that article. I guess it's 30-something years ago, and a light bulb went off in my head, and I said, this makes total sense. And I read everything that Benjamin Graham ever wrote as a result of that article in Forbes, and it ended up changing my life and changing my way of looking at the world and changing my way of looking at how to invest. And so it was a meaningful turning point in my studies. And I was at a business school. I was at Wharton Business School, and we were learning still efficient markets, and they're still teaching the same thing over there. But, you know, it was a little article in Forbes that kind of put me on the right path, I think.
On that note, I think I'll say thank you, Joel, and viewers and unique visitors, keep that in mind.
Thank
It
you.
will make you rich. Oops, the SEC's coming after me. Joel, thank you very
Pleasure.
much.